Did you know there's a specific moment in your investing journey when your money starts growing faster than you do? It's a powerful tipping point, but here's the catch. Most people quit right before they reach it. This is exactly what the 8-4-3 rule explains, and understanding it could completely change how you see your financial future. Let's use a realistic example to break this down. Imagine you invest $500 every single month into a diversified index fund, like one that tracks the S&P 500. Historically, the long-term average returns for the U.S. stock market have been around 8 to 10% per year. To be on the safe side, we'll use a conservative estimate of 8%. So you're consistently investing $6,000 per year. Now let's see what actually happens over a 15-year period. We'll start with the first phase, the first 8 years. During this time, you invest a total of $48,000 of your own hard-earned money. This is what we call the foundation phase, the 8 in the 8-4-3 rule. During these initial years, most of the growth in your account happens because you are consistently adding money, not because the market is performing some kind of miracle for you. Think about it. When you have $50,000 invested, an 8% return is about $4,000 for the year. That's helpful, sure, but it's not exactly life-changing money. And this is precisely where so many people get frustrated and give up. 8 years can feel like an eternity. They go in expecting dramatic, fast results, but instead, they just see steady, almost boring, modest progress. They look at their account and think, is this it? I've been doing this for years, and it's barely moved the needle. But what they don't realize is that this phase isn't designed to make you rich. It's designed to build the base. It's like laying the foundation for a skyscraper. It's the most critical part, even if it's the least exciting to watch. You need a strong base for compounding to really take off later. Now, let's move into the next phase. The next 4 years, which covers years 9 through 12, you continue your discipline, investing that same $500 every month. That's another $24,000 of your own money added to the pot. By the end of year 12, your total contributions have reached $72,000. But here's where things start to get interesting. Your portfolio could now be worth somewhere around $120,000 to $130,000. Do you see the shift happening? At $120,000, that same 8% return is now roughly $9,600 in a single year. Your money is now earning more for you in 1 year than the $6,000 you're contributing. This is the turning point. This is the moment your capital starts doing more of the heavy lifting than you are. Your money is now working harder than you are to build your wealth. And here's something even more powerful. During these 4 years alone, your portfolio might grow by around $50,000. That's almost as much as it grew during the entire first 8 years combined. And what did you change? Nothing. You didn't suddenly start investing more. You didn't switch to a riskier strategy. The only thing that changed was time. You stayed in the game long enough for the magic of compounding to start picking up speed. This is the 4 in the 8-4-3 rule, where the momentum becomes visible and you start to feel the rewards of your patience. Now we enter the final and most exciting phase. The final 3 years, from year 13 to year 15, you keep doing what you've been doing, investing another $18,000 over these 3 years. Your total contributions after 15 years now stand at $90,000, but your portfolio? It could now reach approximately $170,000 to $190,000. That means that nearly $80,000 to $100,000 of that grand total is pure growth from your investments. Let's look at that pattern one more time. In the first 8 years, you saw about $27,000 in growth. But in just the last 3 years, you could potentially see $40,000 or more in growth. The final 3 years can literally produce more wealth than the first 8 years combined. That, my friends, is the 8-4-3 rule in action. 8 years to build the foundation. 4 years where the momentum becomes visible. And 3 years where the acceleration becomes truly powerful. So, what's the psychological trap here? It's that most people quit during those first 8 years. They get stuck in the foundation phase, where progress feels painfully slow. You're being disciplined, you're saving, you're investing, but it just doesn't feel transformative. It's easy to get discouraged and think it's not working. What they fail to grasp is that the power of compounding is entirely dependent on the size of the base it's working on. Let's put it simply. When you only have $20,000 invested, an 8% return gives you $1,600. It's nice, but it won't change your life. But when you have $150,000 invested, that same 8% return gives you $12,000. Same percentage return, but a completely different impact on your wealth. The percentage doesn't change, the base does. And the only way to grow that base is with time and consistent contributions. That's why time in the market matters so much more than trying to time the market or chasing intense short-term gains. Now let's make this even more practical. What if, instead of $500 per month, you were able to invest $1,000 per month? Following the same logic, your 15-year result could approach a staggering $350,000, depending on market performance. Or what if the market gave you a slightly better average return of 10% instead of 8%? The 8-4-3 rule isn't some kind of magic trick or a guaranteed formula. It's a patience test. The first 8 years are designed to test your discipline. The next 4 years begin to reward your consistency. And the final 3 years are when your commitment gets multiplied. And this reveals a deeper lesson. If you stop at year 7 because you're bored or discouraged, you miss the momentum phase entirely. If you stop at year 10, you interrupt the acceleration just as it's about to take off. If you panic and sell your investments during a market downturn, you completely reset the cycle and have to start all over again. Compounding isn't about intensity, it's about duration. It's a marathon, not a sprint. This is also why starting earlier matters so much more than starting bigger. Someone who starts investing just $500 a month at age 25 and stays consistent for 15 years can easily end up with more money than someone who starts at age 30 but invests $700 a month for the same period. That 5-year head start is incredibly powerful. Time is your greatest leverage in the world of investing. The market doesn't reward impatience or genius. It rewards survival and consistency. And once you complete one full 15-year cycle, something inside you changes. Your money starts producing meaningful annual growth. Growth that feels tangible. Growth that builds real confidence in your strategy. And that confidence makes the next cycle even stronger and easier to stick with. Because if you continue investing beyond 15 years, the growth curve doesn't flatten out. It actually gets steeper, the numbers get bigger, faster. The 8-4-3 rule is simply a framework to help you remember one crucial thing. Building wealth feels slow at first. It becomes encouraging in the middle. And it feels incredibly powerful at the end. But you only get to experience that powerful stage if you have the discipline and the emotional strength to survive the slow stage. So the real question isn't whether an 8% return is possible over the long run. The history books show us it is. The real question is, are you willing to stay invested long enough to let compounding do its job? Because the biggest financial mistake most people make isn't investing too little or picking the wrong stocks. It's quitting too early, right before the magic happens. Don't let that be you and stay the course. Thanks for watching. If this helped you see investing in a new light, make sure to like this video and subscribe for more content to help you build your wealth. See you next time.